Next up, we'll be speaking to Stephen Romick. He is the founding partner of FPA and they're based in Los Angeles. FPA are responsible for managing the Global Flexible Fund, and today he'll be talking to us about why price matters. Steve, over to you.
Thank you, Tumi, and thank you, Ned Group, for having me here today. Today, we're going to chat about price matters. The subject of price matters is that we would argue that everything has a price, and one needs to understand what that is to justify the owning or purchasing or selling of any position in a portfolio. And in today's point in time, we've seen a lot of valuations reach particularly high levels as companies are being given a pass as to what is likely to happen in the future with this great expectation that success is going to occur without any particular guarantees of that success. And investors have given companies the valuations that assume that success. So that's going to be the chat today. And if you think back to where we were just a little over a year and a half ago, where peak COVID fear translated into trough valuations in Q1 2020. Since then, the fear has subsided, and governments have pushed interest rates to lows, and we've been living through, as a result, an extended period of inflating asset prices. Most companies have seen their stocks rally, and stock prices rally, and have seen their prices reach levels that we find hard to justify, as if price doesn't matter. As Oscar Wilde once wryly pointed out, the cynic is a man who knows the price of everything and the value of nothing. It is the cynic for whom price doesn't matter, which might be a corollary to the old adage, a fool and his money are soon parted. We are opportunistic value investors. We buy both out of favor more traditional value stocks and higher quality growing stocks at reasonable prices. Value is the price that is paid for an asset. You can have the greatest business in the world, but still pay too much. And you can also have an asset of a lower quality that the world is ignoring, that is priced at a level where it would be hard to lose money, and there's a potential, that exists to make a lot of money. The idea of margin of safety is agnostic as to either business quality or type. As such, we don't need traditional value stocks to do well for us. There's three types of companies that we generally have in our portfolio: compounders, commercial opportunities, and special situations. The compounders are generally the business leaders in their respective industries, and we believe they have a competitive edge. And we believe that 10 years from now, these companies are going to earn a lot more money than they are currently earning today. They got good balance sheets, shareholder-centric management teams, and we think of it as infinite duration bonds with rising coupons. But one can still pay too much for them. And that's where a lot of the excess valuation has showed up in the market. The more commercial opportunities are those businesses that are of a lesser quality. I don't mean bad quality, but of a lesser quality than those of the compounders, maybe more cyclical businesses, maybe not the same level of growth, but still, in our view, good businesses and likely to have greater upside potential. We invest in these businesses when our assessment is the upside is substantially greater than the downside, where you can think of them as 3 to 1, 3 times the upside, at least, to the downside. Then we have our special situations. These are the 50-cent dollars, which could be spinoffs, holding companies, and the small basket of special purpose acquisition companies, or SPACs, that trade at discounts to their trust value that we have in the portfolio today. In early 2020, the cheapest quintile of the U.S. market traded at its cheapest level relative to the most expensive stocks in 2008. As demonstrated in this slide, where the gap between growth and value, it shows you these peakier periods. It's still wide, but not as wide as it was. We leaned into market weakness in the first quarter of 2020 and into Q2 of 2020, and increased risk exposure in Q1 of 2020 by 1,000 basis points in a matter of weeks by purchasing out-of-favor companies, many of which were down over 50% from their recent peak. Some of those could be construed as more traditional value stocks, but many were quite high-quality companies whose businesses were temporarily harmed by COVID and whose prices were being decimated. Marriott and Booking in the travel industry would be two examples, of that. The stock market sets prices for public companies. Each day the exchanges are open. It is up to us to determine if a given business is good or bad, and whether the price that is offered affords us downside protection, that is, a reasonable margin of safety. As Warren Buffett has said, price is what you pay, value is what you get. Because prices fluctuate more than the value of the underlying businesses, we are afforded periodic opportunities to buy stocks. At quarter end, our portfolio looks relatively attractive, trading at a discount to the US and global markets on a price to book basis. On a price to earnings basis, the fund trades at a discount to US stocks, but at a slight premium to global stocks. Notably, the weighted average of our portfolio companies has demonstrated double-digit earnings growth in the past 3 years, as compared to the benchmarks, the US S&P 500, which has recorded a 1% average annual decline, and the global market, as represented by the MSCI ACWI and MSCI World, which has had trailing 3-year 6% earnings growth declines. Can't really call it earnings growth if it's been declining. According to the consensus estimates of third-party analysts, companies in the Ned Group's Global Flexible Fund portfolio are expected to grow at a 32% rate over the next 3 years. This high number includes expected recovery from the harm caused to businesses by COVID. The expectation for companies that comprise the benchmarks are in the low to mid 20% growth range. We suspect the growth, both for the portfolio companies as well as for the benchmarks, will likely fall short of analyst estimates. But if that happens to our portfolio companies in concert with the benchmarks, our less expensive portfolios should perform reasonably well. Sitting here today, the same value stocks have strongly outperformed the market since March, and it's in March of 2020, and especially since the first vaccine announcement. This makes traditional value stocks look far less interesting from a risk-reward standpoint, which is why we have selectively trimmed some positions and upgraded the quality of our equity book. Opportunity is at the intersection of price and value. As Alice Walton, daughter of Sam, founder of the eponymous Walmart, once said, "I know the price of lettuce. You need to understand price and value. You buy the best lettuce you can at the best price you can." Substituting the word company for lettuce, and you have what we do. Seek to buy the best company we can at the best price we can. The most expensive part of the market, as measured by price to sales, is the most expensive it has ever been, even more so than during the internet bubble that kicked off this millennium. While deciles 1 through 9 are historically more expensive than average, again, as measured by price to sales, they still trade at large discounts to the most expensive 10th decile. This offers mostly relative opportunity, but some absolute opportunity as well. A lot has to go right for these companies in the 10th decile to earn equity-like rates of return. Some may do well, of course, but the odds overall are stacked against us. As a result, we don't own any of them. To support the argument as to why the odds are stacked against us, look at history going back to 1979, where success isn't guaranteed just because you have a growing business. The top 1,000 companies, each as measured by size, market cap, have had more than 10% earnings growth in a given year. Let's look and see how they did in subsequent years. In that first year, 353 of the largest 1,000 companies had earnings growth of greater than 10%. But looking out 3 years, only 74 of those companies had growth of greater than 10%. And then looking out over 5 years, only 21 of those companies on average have had earnings growth of greater than 10%. So given such a small percentage of these larger companies, it's very difficult to argue that these largest companies in the top decile with this very, very large high level of valuation, as shown in the previous slide, is going to be supported ultimately by the current prices, and therefore the expected rate of return will be, in our view, will be less than what the market thinks it might be, which again is why we're spending more time in those other tiers, other deciles within that prior slide. So I want to conclude with just the statement that price does matter, and we are mindful of that every day as we put your portfolio to work. Thank you very much for taking the time.
Thank you, Stephen, for your insights on the topic.